Hello and welcome to the Wealth Legacy Blueprint Podcast with your hosts, Richard and Andrew Hanson. I'm your producer, RJ Malik. And Andrew, we're going to be talking about Generation X and Millennials. What do you got in store for them?
Those whiny millennials and the Gen X and their loud music. God, I'm so sick of them. That's not what we're going to talk about. Yeah, get off my lawn. Damn kids. Today, we're going to focus on a little bit of our demographic, the millennials and Gen X. And basically, this podcast, or what we're going to be talking about, how hard my life is and how you boomers have ruined everything. And we're going to try to shed some light on a somewhat dark future. I think financially, a lot of people are concerned. We're going to get just down to the facts and kind of see where we are and what are some of the strategies that a lot of Gen X and millennials use. And I think this will be relevant to anybody's age. It's really, we're just tailoring it to the whiny Gen X's and the millennials and really just getting kind of a different perspective. And we'll be exploring some of the tools that I think everybody could use. So, I'm going to have Rich come in and we're going to be able to, because we got Rich, who's our baby boomer, and he's going to provide us, a little bit perspective on how it was for him growing up. What are some of the things that he went through? And I want to see if we can find some similarities. And if we could all just get along, I think there's something dividing the baby boomers and millennials and Gen X, and we should all just get along and live happily ever after. So that's our goal. We're going to solve world hunger and civil unrest today. Rich, I want to read you some stats, and I want you to kind of give me a little bit perspective on it. Gen X, and now if you're not familiar with Gen X, born between 1965 and 1980. Gen X has an average of $67,100 in their personal savings and $98,900 put away for retirement. Now, those pesky millennials born between 1981 and 1996, the average savings have an average of $51,300 in their personal savings, while their retirement accounts have an average balance of $63,300. Dad, how are we in trouble? What can we do? How is this something that I try to keep a right mindset that we're young. Our best friend is time. We have a lot of time to make these things up. But, kind of, Rich, take me back to the good old days. How was it setting up for your retirement planning? Was there any big, huge event that kind of scared you growing up?
Yeah, I had kids. One of them's there.
Oh, they're the worst.
Yeah. It's interesting, how we all get classified. Obviously, I'm in the baby boomer range. And Drew and my daughter are the millennials. And growing up and being in the position that we're in life now, there's always excuses. Same excuses that happen today happened back in my day. When you're 20, retirement is so far away. I mean, my goodness gracious, that's 45 years down the road. I don't even want to think about that because I don't need to. I'm having fun doing the things that I do, like going to the Rolling Stones concert when I was 20, 48 years ago. And oh, by the way, they just played again in Las Vegas this past weekend.
Yep.
So if they can do
their last tour.
Yeah, exactly. So the same excuses again, and these are typical. They're not excuses; they're reality too. I lived it. Once I got married, when I was 28 years old, the excuse at that time was about saving money was simply, I'm having a great time with my wife. We're traveling. We're doing all the things before those children come. And then ultimately, when the children come, you don't have money to put away because now you're feeding and clothing a newborn, then you're feeding and clothing another one, and all of a sudden, 10 years later, you're in your 40s. And now you've got to start thinking about college, and you don't have time to put money away because now you're getting kids to private school or getting them clothes, and they're getting cars, and they're going here and they're going there. By the time you get to 50, they're almost out of the nest, but you still are paying whatever you're paying for them at that point in time. And then all of a sudden, when they're gone and you're in your early 50s, you're looking at it saying, I haven't saved enough money. Don't be afraid. It happens. It's okay. So the group today, as the same way as my group back 48, 50 years ago, the same things befell us all. But remember, if you can just save a little bit. And I use the analogy, and we didn't have Starbucks back in my day, but I use the analogy today. I don't go to a Starbucks, not that they're bad coffee, I don't know. But I learned a few things in my lifetime, and it's hard for me to spend $6 for a cup of coffee with cream. And that's all I get. I don't have fancy drinks. And I did want to pay $6 so I can go. And this is not an endorsement for any company, other than I can remember I will drive by 17 Starbucks to go to 7-Eleven or Circle K and get a larger cup of coffee for 99 cents. So here's a tip from a guy that walked to school in the snow uphill and walked home from school uphill in the snow
Barefoot.
2 days a week. Two
Yeah.
days a week. Don't drink a Starbucks. And if you're saving $7 a pop a week, there's $56 a month. Put it in a shoebox, and at the end of the year, you got $800, $700, and that's a start, and that's money you don't even know about. So, from the sage old guy, try to do some things now, but understand the insecurities and the pain that is happening to you today happened in every single generation. Just try to make headway on it.
Yeah, I love your shoebox analogy. So, I mean, there are certain things that I think, I experience where it's like, okay, let's cut our eating out down to once a week, maybe. And then you can see, okay, we're going to go grocery shopping. And you don't even have to do the math. You can just see, I have a lot more money than I did, prior to making this adjustment. So, those are kind of the things you can look at and go into further detail, especially just do the math, like Richard said.
By the way, what's DoorDash?
Deliver food, yeah. So if you're super lazy like us millennials and you don't want to go out, you just order food and he shows up on your doorstep. So
that's significantly higher than going to the...
Yes, absolutely. Absolutely. So that's another thing, like cut your DoorDash down to like nothing and you'll see. I mean, like Richard said, that's $6 a day. Do that times 5. That's what? 6, 12, 30 a week. There's 4 weeks in a month. That's $120. So you do that over time, you got compounding interest. Again, I'm not telling you to stop drinking Starbucks. If you like any sort of, vice you have, go for it. I mean, just enjoy your life as much as possible. Like Rich said, there's so much chaos going on. But I want to circle back to what the boomer advice of the day was: take your money and put it in the shoebox. There are so many tools out there. Specifically, the one that I like to use, which I'm going to name drop, is called Acorns. Acorns is going to round up you attach to your debit card or your savings account. Any purchase you make, let's just say, for instance, it's $10.50. You can round up that 50 cents. It takes 50 cents from your credit card and puts it into a savings account. So you just keep spending that. It'll take the remainder, because what are you going to do with change? Nothing. A lot of people don't. Keep my change. So what this app does, and there's a bunch of different apps like that, it'll take that 50 cents and it'll just add it each purchase. You can set it up to where it's almost like a Netflix account. $10 a month I wanted to put into this fund or this, sub account that's based on certain investment strategies and how I like. They're all computerized, something like that. Or even just, like I said, just setting up automatic payments like a Netflix account, where it's like, I know I'm paying $9 a month. I don't look at it. I don't care. Just sock it away. And kind of on that note, I want to talk a little bit about the main tools that I see for our age, because like Rich said, we're having kids now, man. Like, it's chaos. And so one of the main concerns we have is, what if something happens to me? I want to make sure that my family's taken care of. And one of the ways that we do that is with life insurance. And there's, some of the 3 main ones that we see come across our desk: term, whole life, and index universal life. Term is great for, maximizing the death benefit, but you have to keep in mind term it's a one-way solution. So if, say for instance, I have a 10-year $400,000 death benefit, after that 10 years, I've been paying those monthly premiums. After that 10 years, that benefit goes away. So it's a contract, or you're betting on yourself to die within 10 years or 15 years, which is not a great proposition to have. But, there's a lot of reasons why term, especially for our generation, is great, because we're young, we're not able to build up our assets because we're still spending so much money on mortgages, kids stuff, the 2 cars in the garage, the new house, the new backyard. So there's not a lot of ability for us to build the assets, and we're starting fresh. We're building up our equity. We're building up those 401ks, those IRAs, those Roths. So that term, you're paying a small premium. It's going to have a large benefit. So by the time that term does expire, it's almost irrelevant because you've had that time to build up those assets, the equity in the house. You've made contributions to your Roth. So you have all these assets that something should happen. They can, the beneficiaries and the families will be supported that way. But like, anything we do, there's not a one size fits all solution. I think, Rich, we see a lot of term being used in your generation as well. Is there any, what do a lot of clients come in and they say, well, I'm too old, but I kind of want, a large amount. Is this okay? How do you find a way to basically meet their needs and goals?
Well, I think the first thing is budgeting. If I were to rank what you talked about, whole life, index, universal life, or term, I think ultimately the index universal life's the best product because you're betting on yourself to live. And the conceptual idea is you're paying a larger premium for a certain amount of death benefit. And if you don't die, the accumulated premiums that you put into that policy are available in a cash component based upon the inherent rate of return of the investment vehicle within that product. So, if you paid $50,000 over a 20-year period, you may, with reasonably good returns, have $50,000 available. So if you passed away, not only does your family get the death benefit, plus they'll get a return of that capital. The flip side to that is that's more expensive. So what we caution folks to, for example, Drew with his young family, a 4-year-old and a 6.5-month-old, you're in a position where they are protected by you. And we know that emotionally, physically, but now financially. And you've got at least a 20-year period and sometimes more where they're dependent on you, along with a spouse who's caring for your kids. So it may make sense to say we need more coverage. And yeah, we like the benefit of this great thing that we can get our money back if we don't die, but we need to maximize our death benefit. 20 years from now, things can change. You could be less healthy, which means if you wanted additional coverage after that, it may cost you a lot more, plus you're older. But my main thing with the younger folks like Drew that we've worked with in the past is first and foremost, identify what would happen to your family if you were gone with limited life insurance. And it's significant. If you've got a home and you've got 2.5 children, you have a wife who's working harder than the husband who's at home, or vice versa, it's important to ensure a length of time of that employment assets that person is bringing in. So if you're going to lose $100,000 a year in the untimely death of the breadwinner, you want to replace that for how much time? You want a 5-year replacement, a 10-year, a 20, or a 30? Then we'll determine budgeting wise what your expenses are and what's available. So generally, I would say for those younger folks between 25 and 35, it's probably best to do a combination of both. Maximize the death benefit to protect the family, and then also have enough later on that when that term is gone, you've got a prepaid one that you can carry into retirement.
Yeah, and what's cool about the IULs too is so it's index universal life, and so it's a life policy, but it's also an investment strategy. And there's so many different components to it. I could spend 3 hours talking about it, but I'm going to give you kind of the basics of it. One, it's a subcode of the Roth 401k tax code. So if you go look at the tax book, which is like this freaking thick, there's a sub account that allows the IUL to be labeled as a Roth. So essentially, it is working kind of like a Roth. So like Richard said, there's multiple uses for index universal life where term and whole it's not available, to where you have tax-free income while an enhanced death benefit. So, and what's cool about that, it's relatively more expensive than term. So what I use a lot for my younger clients and even my older clients, this isn't, IULs are not just determined for the young. You old folks can have it too. We all can have it. So, but what we
Costs
do
a
is
lot
we
more.
want to do, yeah. So what we want to do is we want to do like a lower IUL benefit, and then we'll couple that with a term. So you're getting a higher death benefit, but you also have another asset or another portion of your death benefit that's growing cash accumulation, and so you have the best of both worlds. And that's kind of why I bring it up, because not one size fits all. Like Richard said, you want to get with somebody and go, I want to determine, do I need this much coverage, or do I really need to be overinsured? Because we see a lot of people get overinsured for like millions of dollars, and it's like you're spending all this premium for something that it's nice, but are you aware that a benefit and the cost of premiums going to that that term policy? Because once it ends, it's done. So that's a lot of sort of the studying and the knowledge that we provide to everybody that comes into our office. I also want to talk about so the millennials and the Gen X are now having babies. They're having little millennial babies and Gen Xy babies. What in first part? So a lot of people are, how do I plan for college, or is even a college a thing? Because for me, I think personally in the future, college is not going to be as important as it was back then. Rich, can you kind of attest to that?
I would say back in my day, they had stressed college education, college education. I think even for you, it was the same thing. But there are
Yeah.
trade schools that people have been very
Yep.
successful with. There are self made folks. And the pricing of the college education now is absolutely absurd.
Yeah, it's just a headline today. It's the absurd interest rates. Somebody I was reading the other day, somebody had a $150,000 student loan for some degree that they don't really utilize, and now that they haven't paid it, it's almost doubled to 250, which is a crime in itself. But we'll not get into that.
Yeah, yeah,
But
yeah.
it's going to be a brand new world, I think, when our kids grow up. Like you mentioned, trade school. I think trade school is perfect. A lot of electricians and a lot of trade specific industries, they make a lot of money, and they don't have that looming debt over their head. So a lot of people my age, or even some of the grandparents that come to me and they go, I want to set up something for my grandkid, or I want to set up something for my kid. There's really multiple ways that you can do it. You can do it through savings, 529 plans. What we like to do a lot is those index universal life policies. Is we use those for the kids too, because that's perfect for that. My dad did that. Dad, can you kind of explain how that came about and like?
Well, when I first started in the business, I well, not when I was first in the business, I was a teacher at the time. And I had a 403B, and they had a regional rep who came and visited with me. And after much discussion, he had recommended that we get. I mean, we didn't have what they call index universal life. We had universal life, which same component, but not the potential for greater returns. And he said you should consider doing this for your son and daughter. I said, well, why would I do that? They're 1 year old or 2 years old. And he said, because at that time, we used a product called Whole Life. Well,
Yeah.
the premium and the cost of insurance was at their current age of 1 or 2 or 3 or 4 years old. And that number is never going to change. So we got a fairly significant amount because it was real cheap for a 2 year old or 3 year old. And lo and behold, they still have those policies
Yeah.
down right now. Drew in his mid 30s, my daughter in her early 30s, and they're paying premiums on $250,000 worth of coverage that's based on a 2 year old. And all the money
Yeah.
that they've put in there, the cash is available for them and some. So I
Yeah.
think it's a great planning tool. You guarantee their insurability. The odds, the statistics of having a tragic situation are not there, but what you're doing is you're planning for the future. But again, it all comes full circle. You've got to look at your budget. And the first thing we work with for the younger folks is really get your budget in order. Are you doing the right things? I mean, I've got a TV that's got every component. It's got Apple Direct TV. It's got all these things on their Disney Channel. I don't know how to use any of them. All I know is I have ESPN. What am I paying on them? Well, I'm privileged and I'm blessed that I've been doing this for as long as I've been doing it. I don't know, but I know if I want to watch Disney, I can do that. But when your budget is a little bit down, you need to take a look at those things. And I hate to go back to the Starbucks thing, but hey, can you do without one of these apps on the TV? What do they cost? $4 or $8 or $12 or $16? Get your budget in order. That's the most important thing. And then from that point of view, then you look at all these other things to protect your family, ensure their protection. Look at what things are going to be like later on down the road. And if you have additional dollars, you get a hold of a guide like a Drew, who will lead you up that Mount Everest of life and show you the tools that will get you there. But most importantly, look at that budget and wills and trusts, those kind of things, to protect you in the event something happens catastrophic to husband and wife. You want to protect your children in the long run. Not real expensive, but those are things you need to look at too.
Yeah, and I think IULs are perfect for the kids too, because like you said, you start them early, and then you're paying at that two-year-old rate. And you just like anything we do, it's a Netflix account. I'm paying for that. You sock it away for the kids, And IULs are great because it offers a lot of protection and tax-free income, but it's not as aggressive as I think a lot of millennials and Gen X feel. They want to put the pedal to the metal. Let's get some sexy, cool stocks. But IULs are not sexy. They're reliable, but they're not the sexiest product in the world. So when we talk about funding for the kids too, we want to talk about, the two biggest options that millennials and Gen X have for their kids is UGMA's, Uniform Gift Minors Account, or the 529 plan. Now, the 529 plan is great. The only reason why I stay away from those, and generally, again, anything I say, it's really my opinion, and I lay out the numbers to sort of back them up. The 529 plans are very restrictive to where you have to use them specifically for college. So you have to use them for, whether that be textbooks or in on-campus dining or rooming. They have to be specific to that campus, because now we're seeing a changing landscape, and I think the government is seeing that too, to where college is not as, foreseen the number one thing to do. So if you have a 529 plan and you spend it outside of any college necessity or any use for that, they're going to charge you 10% penalty. So that's kind of where I kind of stay away from that, because, the future is never guaranteed. We don't know what it will look like in the next 20 years. So, and the reasoning and the evidence why I think the government is aware of that is because now they're allowing 529 plans to be converted into Roths, which is cool. But, keep in mind, the government does something on the other hand. It's like, well, what's their motivation? They're looking for a tax consequence. So whenever you do the 529 plans, you can convert it to a Roth. There's a taxable event. So that's something, I think if you have a 529 plan that's 15 years or older, look into possible Roth conversions. Again, like anything you do, you always want to make sure you have the numbers and the facts before you make that decision. And Rich, I'll go back to you on the IUL. When I got married, my dad came to me and said, here's your IUL plan. You can do whatever you want with it. You want to keep the premiums going. You want to take the cash pay for the wedding. Perfect. And that's what I tell all my clients with kids. It's like, first off, do not tell them that they have that account. Just say they're taken care of. Do not show it to them. If I was 18 and I found out I had even $100, I would spend it all. So try to keep it as concealed. Let them know. They're on a need-to-know basis. They don't need to know anything. So, but what you're doing is you're building a gift for them, whether they hit 18 or whatever event you think is appropriate, whether they're getting married or they graduate college, you're building that gift for them. So you say, hey, I did all my work. You're here. You made it to the finish line. This is your gift. You can choose to do what you will with it. I love you. That kind of thing. That's really what I like to preach to my clients. We're gonna end on a final note, and I think really want to stress how important it is that we start, especially our younger generation, start planning, because, we can have fun and say, don't spend Starbucks. But, one of the main concerns that we have is really, I'm going to read some stats direct from the Social Security Board of Trustees. Annual report in 2024 projected that the trust fund reserves used to pay the beneficiaries of Social Security are expected to become insolvent in 2035. So once the Social Security trust funds run out, which is expected to occur in about a decade from now, benefits will be cut by roughly 20%. If trust funds are depleted, Social Security benefits will face to cut a monthly checks, with the agency projecting the recipients would lose 70% of their current benefits. Rich, why did you do this to us? Why did the boomers not prepare for this? And should we be concerned, or should we, take this as motivation, as less, benefits? We're taking the power back, essentially. We're able to dictate our retirement.
Yeah, I think ultimately you have to take the power back, because the statistics, when they first started the Social Security Administration and the benefits, they were based upon a mortality level of certain ages, both men and women. And they could put the numbers together and the probability of death over a period of time that people put money into their Social Security benefits. They didn't have enough time to collect, and the government was at a break even and actually making money. What's happening in today's world is people are not dying. Now, that's a good thing. And they're living longer, and that's a good thing. Medical science has improved, and that's a good thing. Medical science has improved, and sometimes that's not a good thing, because people are still alive. What killed people years ago does not do that anymore. And the pressure on the Social Security Administration and paying all the blue hairs over their lifetime, the numbers they put together just won't fulfill the requirements. And I will tell you this, they won't change that till the end of this baby boomer group starts to die out, because you don't want to run on whatever White House is going to be around at that time of a bunch of gray-haired old people with walkers saying, don't take my Social Security. But what will happen, I truly believe, personal opinion, I think what's ultimately going to happen to the generation is they're going to take whatever benefits they're going to pay you over that longevity or period of time that they promised. They're going to come back and say, we're going to give you 50% of these assets, go manage it yourself. And that's what you're going to get. And there's no more Social Security. Again, my personal opinion, which could create immense issues. So not only do we have to save money, budget money, try to put things away, but I think your age group, the millennials, and what's the other one?
The Gen X.
Anyway, your age group. Yeah, the Gen Xers. Yeah. You guys face things that we never thought of facing. I know when I turned 65, I was happier than a clam, because I was now in a position where I had my Medicare, a great medical insurance coverage, which is paid for by the government. But if you make X amount of dollars, you have to pay more. But I actually elected my Social Security earlier because I could. And we put together programs that show us if you live to this age, it's best to do that. So a lot of us baby boomers are taking it at the first time that we can take it, because we don't know how long it's going to be there or how much it will change. So it's a big concern for the group. How you solve that, I don't know. Save more money. But then you're on that spin cycle again. How do you save money when you got these kind of bills? And God, that's way down the course. But I think ultimately the government will figure it out. Will it be in your benefit? Unequivocally, no. So therein lies your conundrum, and how do you work with those kind of things? Because like my dad used to say back in my day, he says, I won't be around. And I said, when this happens, I'm probably not going to be here. So good luck to y'all.
Yeah. It's like, yeah, have fun. Enjoy what we left.
Yeah, sorry.
No, I think,
sorry about that.
I think, yeah. And you said, I don't think the government is going to do anything anytime soon with Social Security, because like you said, nothing scares the government more than angry boomers. So, they'll get there. They'll get to the steps eventually with their walkers and wheelchairs, but they'll be boomers will take back what's theirs. I'm sure. but I kind of read that as something that's, I mean, it's a bit encouraging for the most part, because now we can prepare not knowing, Social Security is concrete. We're able to sort of build up something and rely on ourselves. If we get it, great. If not, that's fine. We've been prepared. And that's kind of what the strategies and tools we use is we're able to project that all the way up until age 80, age 90. So we're prepared for anything. And, if you want to take one thing away from this, whether you're Gen X, millennials, just the little steps. The little things make a big, big difference. If you compound that over and over again and you're consistent with it and you stay on top of it, it's not as hard as it seems. It's a bit overwhelming, but this is your future we're talking about. It's hard to look forward to that. So again, speak out to your HR reps, reach a trusted financial individual, and just bring up a conversation like we do with all our clients. It's a conversation we're having, and we want to make sure that we can make this as digestible, easy to understand, and let's have some fun along the way. We want to be serious about this, and we want to get those numbers correct, but let's turn that frown upside down going forward and know we've done everything and we're prepared for everything, and let's just take the world by storm. So with that being said, I want to thank Richard for providing us the multiple segments of Boomer Advice of the Day. We'll be continued doing that throughout. Dad, I do want to thank you. I do appreciate it. It is good to have that sage old will. So thank you for stopping by and kind of providing insight for us whiny millennials. You can check us out on www.generationswealthmgt.com. Stay tuned. Check out our YouTube page. We'll have, again, multiple videos. We're trying to get better. We're getting a lot of great feedback, and we're always constantly learning. So honest feedback, some of the subjects you guys want to hear about is perfect. Going forward, thanks for stopping by, and always appreciate your vote of confidence. Take care.
And thank you, gentlemen. Looking forward to your next podcast. And thank you for listening to today's Wealth Legacy Blueprint podcast. Please like, follow, and share this podcast with friends and family. And until next time, I'm your producer, RJ Mallett.
That's a wrap on today's episode of the Wealth Legacy Blueprint. Don't be a stranger. Hit that follow button to stay connected. Got questions? Need some personal finance tips? We're just a click away at www.generationswealthmgt.com or give us a ring at 1-833-948-2466. Remember, it's about more than money. It's about your journey to financial freedom. Stick with us for more real talk and real strategies to make your financial dreams come true. Opinions expressed here are our own and our guests, not necessarily those of Generations Wealth Management Group. This podcast is all about education and not direct financial advice. For the nitty-gritty on your own financial situation, always chat with a professional.